this thing going. All right, guys, this is being recorded. One thing I say at the beginning of all of these is watch it again. Even if you know what a long straddle is, you guys, I know, or a long strangle, sorry. I know you guys can look this up online and figure out how to do a long strangle, kind of. I have a lot of rules that go into this and some nuances that you may not have known before or thought of in that matter. So even if you're new to options or a savvy trader, watch this again. Watch it through the first time. The second time through, it'll kind of go into your long-term memory. So this is going to be recorded. Usually it takes me about an hour after the video to, convert this, send it out. It's either going to come out either tonight or tomorrow morning. So that would be the best time to watch it. If you wait 3 weeks, 2-3 months down the road, you guys, it's going to be like learning it all over again. You're going to have to pause it, and it's just not going to sink in like it would if you are to watch this again relatively soon afterwards. So then on to a couple of things I got to go over real quick besides this is a long straddle. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Been trading my money for almost 25 years now. Started out trading in college with a psychology degree. Started trading, switched it over, my degree over to a finance degree. And basically, after graduating college with a finance degree, I moved up to Chicago, started working on the floor, running around as a runner, the guys that run the paper into the pit, and then sold all my stocks, bought my badges, jumped in the pit and started trading. So I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products and basically all market conditions. And now I'm a screen trader. So I've basically been around the block and pretty much seen all of it. Good to have you, Bob. Nice to see you back. Any opinions, news, research, or analysis, or other information provided by ProTrader Strategies or associate companies does not constitute investment advice. Doesn't. At the end of the day, I'm going to be talking about stocks that I have in my portfolio most likely, and I'm not trying to get you guys to limbing off the cliff with me. What I'm trying to do is teach you guys some strategies to put in your portfolios, but you need to make sure you take your own portfolio into account and your own risk parameters, because sometimes these risk parameters might exceed your risk levels. So make sure it's appropriate for you before implementing it. We're trying to teach you how to swim, not swim for you. Please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, so you can also follow me on Twitter at Wolfman's blog, and our parent company is at ProTraderStrat for all kinds of trading advice and or snark coming from me. How to follow or how to trade the long strangles. Now, like I said at the beginning of this may seem like a very easy thing to do, is setting up a long straddle. Online, you're going to find buying out of the money put and buying out of the money call. All right, go do it. All right, what does that mean? And why would you just, what trade location, when are we going to do it? My rule of thumb is you kind of start around the 30-ish delta. And the reason why is because it's a higher probability strategy in that regard. What we want to have happen is to go out there relatively quickly and test these strikes. So a 30-ish delta, has a 30% probability of being in the money at expiration, but there's a much higher probability that these strikes will be tested in the duration of that strategy or in the duration of that expiration cycle. And on the floor, we had a little floor trader hack, and it was basically 2 times the delta was the probability of being touched, or probability of being tested is the way we used to look at it. If we did a 30 delta strike, we thought, all right, well, there's a 60% probability I'm going to be tested sometime during the duration of this duration of this option expiration. So, when you know what the probabilities are, you're going to sleep a lot better at night. You're just going to know it's getting close to my strikes, and, some people want to hit the panic button. If you know the probabilities, well, there's only a 30% probability it's going to be in the money at expiration, but I got a 60% probability of being, tested on this, to test my will, if you will. Then you're going to sleep a lot better at night. You're going to be able to know that when you're losing money on it because it's going up there to test you, it's not necessarily the time to pull the ripcord, okay? But we're going to be starting this strategy out picking a 30-ish delta. And I'll go into more detail in and around that. So the essentials to success is picking the right underlying, you guys. I do these webinars all the time, and at the end of this, I'm going to say, hey, you guys, throw out some stocks that you guys like to trade, and we're going to go through these steps and see if it's appropriate for this particular underlying. I think it'll help you guys learn it a little bit better, but it's inevitable somebody's going to throw out a stock that I've never even heard of, and a lot of you may have heard of it, but at the end of the day, I'm only trading the stocks that have a lot of implied volatility, a lot of volume and open interest. That means there's always players in there. It's kind of like, if you think about it, if you ever seen pictures of the floor, the trading floor, you want to be in the pit that has thousands of people. It's the big bond pit or the big S&P pit, because there's always somebody willing to give up a bit of an edge, and it creates a tighter market. And if you're in the catastrophe insurance pit, there was two guys in there. So the bid ask is going to be much wider because there's much, they can make the market whatever they want. And that's the same thing with stocks, like Aon even. Everybody's heard of Aon. I mean, they sponsor soccer worldwide. Everybody's heard of that particular stock, but there's nobody trading in those options. And that makes it a really wide bid ask. And the reason why is because they can't, and something like Apple, there's so many people trading there. If I put it in a bid, well, somebody else is like, well, you just bettered my bid, I'm going to give up another penny to step in front of you so I get filled first. And that's the kind of real market price discovery we want to be involved in, because we don't want to have to give up a lot of edge to get in and a lot of edge to get out. If, it's 50 cents wide and I've got to give up a quarter to get in and a quarter to get out, that's 50 cents, right? That means you're going to be stuck in that trade for quite a while. You might see Theta Decay happen this under the market increases in this regard. So if I paid $1 for this strategy and the market goes my way and increases by 50 cents, well, maybe I'd have to get out. It might cost me 50 cents to get out of it because it's a quarter on one side and a quarter on the other side. That's 50 cents. So I got in for $1. It's trading $1.50, but I have to give up 50 cents to get out of it. I get out for $1 and I took all this risk. It doesn't make sense. All right. So make sure the bid ask is tight. And when I talk about the bid ask being tight, a stock under $100, we're looking at the bid ask and that option montage on the expiration cycle that's like closest to 35, 40 days, okay, because that's the ones that usually has the most participation in it. We want those bid asks to be inside of 10 cents. And any stock over $100, we're going to be looking at moving the decimal point. If it's a $500 stock, move the decimal point 3 ticks to the left. That bid ask should be 50 cents wide. $1,000 stock, 3 ticks to the left, it's $1, right? Okay, so that's the idea. I want you guys to make sure you stick to that, because if you're trading these stocks where nobody is in there and something starts getting jiggy and volatility expands, those bid asks are going to even get more wide, or wider, I should say. So stay away from those ones where there's just not a lot of open interest and participation in there. And we'll go into some more detail when we get a little bit further around. Picking the right strikes, I mentioned this right off the bat. We're going to try and pick one standard deviation away, or actually a half a standard deviation away, which is right around that 30-ish delta. So we're on either side, because then our probabilities are much higher. We don't want to get too much closer to that, because then we might as well do the straddle, which I've already done the webinar on the straddle. So we want to get away from that. We want to just save our costs. It's going to lower our costs quite significantly by doing the strangle, than with the straddle. But in that, in a sense, we're increasing our risk a little bit. We're paying less, but we're increasing our risk because we're lowering our probabilities of success in some regards by if the underlying stayed right where we currently are today, then we're going to lose on both sides. So we want it to move for one, and two, we want to be a little bit tighter. We don't want to do like a 16 delta because then there's only a 30% probability it's going to get all the way out there. It's to me, it's almost like you're throwing your money away. All right, so picking the right duration. We want to go more than 30 or 35 days. Usually when I'm talking about like doing option collection strategies, we're doing it somewhere inside of 35, 45 days. This we want to go 50 days out or more. And the reason why is because we don't want this. This is kind of a representation of theta decay. And this is what happens to our premium when we're a premium buyer. It decreases every day that goes on. So as you can see, it's a slower regression until we get inside of 35, 45 days. And then you start to see it dramatically increase. We want to get out here further. For one, we want to limit our theta decay. And two, we also want to give ourselves the opportunity to be right. And the longer we're in this kind of strategy, the more opportunity we have to be right. A lot of things can go on in that time. Picking the right environment. With this one, I mentioned this, we want low volatility. As low volatility as you can get, as a matter of fact. I mean, zero volatility would be great. The reason why you want low volatility percent is because the probability is volatility is going to expand, and then that helps the option buyer. If you get into this strategy and you're in an IV percent of above 50 and that volatility contracts, that hurts your premium, even if you're directionally right. Because what happens is when volatility is in the market, it has a tendency to push this curve up a little bit. So as volatility comes into the market, what it does is it inflates those premiums. So it kind of pumps these up, all right? So it holds off theta decay, all right? And then when volatility comes out, so if you get into a high volatility environment, when you put this on or volatility goes down, what it does is it speeds up and catches up to this curve. So we don't want to do that. We don't want to be buying here. And then even if the market moves our direction, that premium comes out, that's going to really hurt. So we want to stay away from that type of situation. So the lower ID percent you can find, the best. And when I'm talking ID percent, every stock has its own implied volatility, okay? And what we're looking for is a low, very low implied volatility percent. So this is implied volatility. Every underlying has its own implied volatility. And what we're looking for is how is this volatility in relation to where it's been in the past. So what we do is we take what the current ID is of 14 and divide, or sorry, you have a numerator and denominator. We're taking two sums and dividing them by each other. And in the numerator, we're taking where the current implied volatility of 14 is, subtract that from the low, which is 6. So we have 8 in the numerator. That's the sum of those two there, ballparking. So then we take 8 and divide it by the sum of the high, which is 30, minus the low, which is 6, so 24. So 8 by 24, this means Microsoft is in basically the 25 percentile, right? No, sorry, in the 30 percentile. So knowing that, this would be a candidate possibly because we're talking in the below 50 area. And the reason why you got to know that fraction, the numerator and the denominator stuff, is because sometimes you get this break in the action where the chart breaks for some reason and the algorithm cannot come up with an answer when there's a break in it. So you need to know that for that reason also. And some platforms may not have this as well. So current in the numerator, the current implied volatility minus the low, You take that sum and you divide it by the sum of the high minus the low. And I ballpark that, you guys. I'm not a savant, but I can kind of ballpark it. All right, so the next thing the reason why all of those rules are really important, you guys, I've got a couple of examples. These are old. As you can see, the expiration, it's basically saying 9/16/17. So this I did a long time ago. And the reason why it was, so they're a little bit old on the charts, but I don't want to like beat around on that. The idea behind this is that, these two examples I'm going to show you here pretty soon is because they were very close to trading 60 and they had the same kind of strike setup. Sometimes the options have dollar strikes, sometimes they have $2.50 strike. These two had $2.50 strikes and were trading around $60, but they had very different implied volatility percents. So for instance, this is Nike, ticker symbol NKE, and what I did is did the September 57.5 puts, which is right here, and the 62.5 calls. Okay, so that's the width of our strangle, and they were right around the 30-ish delta. Okay, and I paid 93 cents for this strategy, or it was trading at around 93 cents. So you can see the market doesn't have to move very far from where it's got to move, $3 to either direction, $3.50 to either direction in order to be right. And it's, lined up around the one standard deviation. Inside of one standard deviation move, we were very profitable. So, as a matter of fact, you're at about a half a standard deviation move, you started becoming profitable, which is good. Now, this had an implied volatility percent of about 5, a 5 IV percent when I set this up. Now, if you increase the volatility on this underlying, now your break evens are still the same because you were able to buy this in a low implied volatility. But when we increase the volatility on this, you can see that all of these numbers came in slightly, and this kind of seems like I have the same. I think I have the wrong chart on this. This doesn't show the implied volatility expanding very much. I think okay. So actually, sorry, yeah. So look at this purple line. This purple line I usually ignore. So that's at inception profitability. And when volatility expands, you can see it brings you into profitability faster is what that does. It's not going to change the parameters of when you set it up necessarily, but if we increase volatility and the market didn't move at all and volatility increased today. So, if we put this strategy on right now, it's basically saying you aren't profitable. It is right here. But when you increase volatility, even if the underlying doesn't move, you can see that when this purple line expands away from the zero line, it means that you are profitable in a sense. That's the takeaway here. So as volatility expands, this is kind of showing you in a different way how those premiums are inflating. So in a sense, I'm already profitable. Okay, because I've paid $1 in this one. I'm not profitable until we start seeing a movement happen rather quickly. And this shows that if volatility increases, that profitability comes faster when that underlying moves. So this is really an idea of the underlying moving in that direction and what your profitability would be in relation to that. So this is another example, and I'm sorry the chart looks a little bit wonky. I mean, I spent hours trying to get this chart to look similar to the other one because they should kind of diagonal off, but it didn't work out very well for me. But in a sense, if you look at this, this is Lululemon, ticker symbol LULU, and instead of having a 5 ID percent like Nike did, when I was looking at this one, the ID percent was 45%. So it was like right in the middle of its high and its low in a sense. So very close to that 50. Now I said you can implement this strategy below 50, but I would encourage you to implement this strategy when IV is as low as possible. Unless you were really sure this underlying is going to move and volatility isn't going to contract. So in this, the difference being, I picked the same strikes. I picked the 57.5 strikes, which is right here on the puts, and the 62.5 strikes. So that was the same strikes I had in the Nike, you know, the 47 or the 57.5 and the 62.5. But with this one, I had to pay $4.75 versus the 95 cents, which throws my break even all the way down here below 53 and above 67. So you can see the difference there. I mean, that in and of itself is an extreme, not super extreme, but I'm trying to show you the importance of implementing this in a low implied volatility environment. Did I lose anybody on this? Because this is a really important concept. Low implied volatility, and that I can't emphasize enough, especially with that strategy. You can just see that, you know, going from 57.5 to 67.5, the probabilities of that happening versus the probabilities of it going all the way out to 52.5. I mean, that's a huge move, right? We can all agree on that. You got to get a big move with that. Now, if I wanted to set it up where I was like, all right, good. If I wanted to say, you know, I want to set up a strangle, I only want to pay $1. I don't want to risk a whole lot. Well, this is what you're looking at with Lulu. You had to go all the way out to the 50 puts on the downside and the 72.5 calls on the upside to only pay less than $1, or right around that 93 cents area. So massive amount. I mean, literally, you have to go outside of one standard deviation move in order to even get close to your break even. That's like halfway. So the probabilities of this happening with Lululemon was probably about a 5% or a 5 delta strike on these when I set this up in order for that to occur, which means there's only a 5% probability of you becoming profitable, and you know, maybe a 10% probability that you're going to get tested on it, which is highly unlikely. All right, so another thing is, let's know our exit strategy before entering this trade. We're paying a debit. It's a low probability strategy, lower probability than, saying, collecting premiums. It is a rather safe for the newer trader because you know what your risk is getting into it. It's that debit you paid, right? But we want to look to take, if we're losing money, if we paid $1 in that example where we're 93 cents, let's just call it $1. You know, if we lose 50% of that value and it's trading at 50 cents, I'm probably going to look to get out of this. I'm not going to stick in this trade very long, because the idea around this strategy is, when you set it up, you think that there's going to be a move happening rather quickly. And if you're in this trade for, 2 weeks, I would really seriously think that it's not happening anymore. Another thing, one thing I forgot to mention with the duration, I don't care if there's earnings in the duration. So as a matter of fact, that'll actually help you if you do this 70, 60 some odd days out and there's earnings in that expiration cycle. That will help you out. Even if you're directionally wrong, right? Volatility expansion helps us. That is the environment we want to be in. So a binary event in and around that will help us. Same thing with, like, I think last week somebody had brought up a biotech, and I'm not really sure if there was a trial result where they're testing the drugs and then they're going to come out with the results of that. But that will have a tendency to explode volatility. And so something around that's another binary event. Fed funds, our binary event when I traded on the floor was the FOMC, which is coming up next week. So volatility is expanding heading into that FOMC for bonds and the treasuries, if you will, because of that binary event we're seeing with the FOMC. Same thing with stocks. Binary event is just like an earnings, or sometimes even with the dividends. And if they come out with anything, we saw volatility expand for Apple with this new release of the phone as well. So those types of things are what we call binary events. So having a binary event in and around that expiration trading cycle, that's good for us because that expansion helps us. So we're looking at taking a loss at 50% drawdown in what we paid for it, or trying to get it 2 to 3 times more than what. So if we paid $1, I'm going to be looking at getting out at, about actually 50% increase in it. So $1.50 or $2 would be on the very high end. Another thing I look at, so I'm looking at a 50% drawdown on a loss or a 50% increase, so $1 to $1.50. Another thing to keep in mind, if this happens rather quickly, this is kind of a rule of thumb for exit. Days in the trade for a long straddle. If I'm in this for only 10 days and I've got a 20% increase, I'm going to be pretty likely to start looking to cover this. 15 days in at 30% increase, 20 days in at 40% increase, 25 days into it, 50% increase. And that's where I'm pulling the ripcord. I don't care about the rest of the days. I'm going to be cutting out of that. So have a short leash on it. You pay $1, you get out for $1.50. So what this is really saying is, if you want to look at this as less than, not more than. So less than 10 days in the trade, 20%, less than 15 days in the trade, 30%, less than 20 days, 40%. So those are kind of the rules of thumb to kind of get in and get out of this strategy, okay? So it'll help you kind of stay on task, if you will. How doing, Shady? Good to see you back in the house. All right, so max profit on this trade. We're going to be looking at it as unlimited, right? But I'm going to be getting out at a 50% increase in the in what I paid for this. Max loss is the premium I paid. Anytime you pay a debit for any type of option strategies, any option strategy, the premium you paid is your max loss. And we have 2 break evens because we have a put and a call, right? So our I kind of briefly ran over this, is the underlying price is long call strike plus the premium paid. So in that one example, we were looking at Nike, the, what was it? I forgot the strikes already, 62.5 calls. If we paid $1, it would be 63.5 to the upside, and the 57.5 calls, I believe, was on the downside for the puts. Then we subtract that, so 56.5 would have been our break even to the downside. So that was all kind of shown on that chart. All right, so this is usually where I kind of throw it out to you guys, throw out some stocks. I have some of my own that I have vetted, but I think you guys will get a little bit more from it if we go through some of the stocks that you guys like to trade, and we go through that as well. One thing I do is throw this up over the side. This is the ID percent, which basically does the math for you over here on the side, so I don't have to do that all the time. You can also find it when you go into your stocks over here. You can find it down here, especially if you're using Thinkorswim. It's the ID percentile, current ID percent is what we're looking at. All right, first one I saw was AbbVie, right? AbbVie. All right, and I'm going to have to say they are an $83 stock, and it's close to 10 cents wide. I've traded AbbVie, and the markets actually used to be a lot better. And I used to trade them a lot more when I lived in Chicago because they're kind of a Chicago company. And I knew a little bit more, got more news on them for the most part. But this is very close borderline on bending that rule. If you do see that they do have a lot of volume and open interest, I mean, it's okay. But I bet when we get out here for this other stocks, okay, well, they do have still pretty good open interest in there. It gets a little wide out here, though, so that's part of the problem. We're giving up a lot to get in and out of this. IV percent though is just shy of 50. I don't know when their earnings are, and I really don't care as long as I expect volatility to expand. Did they have some kind of something coming out for a trial or anything that you know of? I haven't done a whole lot of research on them. Did they do a trial research or anything? So I'm going to be looking, like I said, outside of that 45, 50 days, so 63 days works. I don't like going out like 120 some odd days because you end up paying a whole lot for this. So I want to look at the delta and the gamma. So our delta, the 30-ish delta, so that's about the 35 there in this one. So we're going to be looking at those two strikes to buy, but I'm going to have to pass on that. I just think that with this chart, it really skyrocketed. It kind of blasted off. Volatility expanded. I have a feeling volatility is going to come back down. So I think that the premiums are going to come out of that for you. So I kind of want to stay away from that. All right, the next one was Johnson & Johnson, J&J, which is a stock I like. Okay, so it's a $134 stock. This is the rule I was talking about. It's a $134 stock. Bid ask should be moved to 3 ticks to the left, somewhere 13, 14 cents. And it's right in line with that 15 cents. It's close enough for government work, especially way out there. If we look at the ones that are 35 days to expiration, you're going to see they're probably right in line with that 14 cents. So that's good. Even these are even tighter than that. So that works for me. It's IV percent is 46. It's a little high. As long as I expected IV to start expanding in there, that would be okay. So we could look at their earnings. J&J, sorry, a tickle coming. So their earnings would be within that cycle that we're doing out here. So their earnings are coming up actually in this cycle out here. So we're going to see volatility expand during that time. Good. Beauty is we just got out of earnings season. We're just getting back into it. As a matter of fact, Nike reports earnings in 10 days, actually 11 days. So that will have IV probably expand. So I'm gonna give you that one. We're gonna look for the 30-ish delta. I'd probably lean towards these 25s. It's trading 35, so that's only $5 to the upside. So I'm gonna go with the 20 delta on here. So I'm gonna buy those. And then I'm going to look to the 30-ish delta here, which is these here. And it's, yeah, $2.39. So that's pretty good. As long as we expect volatility to expand, which I believe it will. As you can see, it doesn't go down from their earnings cycle very much to this one. So they're all going to kind of perform the same way. $2.39. So when the underlying is trading to the upside at 140, 239, that's our break even to the upside. And to the downside, it's going to be 127.61. All right. So those are our break evens to the upside and the downside. All right. And I would probably do this as, especially if you have an account that is, let's say $10,000, I'd probably do this as like a one lot, $10,000 or less. On a $100,000 account, I'd probably be looking at doing this at probably maybe a 5 lot or something. Somebody's asking about quantity on this. So maybe risking like $1,000 in a sense for a $100,000 account in a sense. A little bit less on a $10,000 account because you're going to have a lot of other things going on in it. Okay. So, all right. So limit 27 expiration takes earnings release. Yeah. So it'll be in on that. One thing about the earnings, we want the expansion and volatility, but what happens in earnings after after we see the earnings happen, right? So let's look at this. This is what happens afterwards. Going into it, we're going to see, we're getting in a month or so beforehand. We're going to see volatility expand going into that. You guys, right or wrong with this strategy, especially with something like Deere, you can see how dramatic volatility comes out of that. Remember, we don't want volatility coming out of this strategy. So I would say right or wrong in this strategy, unless you're deathly wrong on this strategy and have lost basically all the premium in this underlying, you're at like, you paid $1 and it's trading like, 10 cents or a quarter or something like that. And there's just, at that point, it's kind of like, why not? I probably wouldn't ride this through the earnings because volatility comes out of that. You could be directionally right and still lose money on, at least lose more than what you had in there, right? You might still be profitable, but that volatility collapse, you're just going to be like, what was I thinking? I was directionally wrong before, but I had a heck of a lot more premium. So get out before that binary event, even if it's the last day. That earnings comes out after the close, just get out of it. Unless it's basically already decayed to worthless and you've kind of ridden it into the ground. Okay. All right. Oh, Lockheed Martin. Okay, we'll get to that here in a second. So I'll try and speed up so we can get a couple more of these. XLE. XLE, it's kind of made a good run. It's kind of topped out. Maybe we think it's going to either explode through this to the upside or down. Take your own technical analysis into the whole situation. I actually like to see it when they've kind of wound up real tight. They've traded sideways for a while. And then, something like, for instance, with like Boeing, when they get kind of trading sideways like this. I always talk about this as that's like a rubber band getting wound really tight, and the market's ready to spring in a sense. It's like you're winding that propeller on the old school airplanes, where they got the rubber band that drives the propeller, and you're winding that thing up really, really tight. The longer you wind it, the tighter it gets, and the faster it releases. So it's kind of like creates pent up energy in a sense. So I really love doing these strangles around something like that. Straddles as well. And you can see it had low implied volatility or pretty low implied volatility in a sense. But back to XLE. XLE is a $65 ETF for the oil or energy anyway. And I'm looking at the 35 days here. No, I've got November in there. Oh, that's from the old one. So we'd have to go out to like the December, which is fine because they don't have the November. They'll probably get the November on Monday as soon as these September go off. But just for sake of this, we're going to be kind of looking at the 30-ish delta right in the middle. The 36 is kind of the sweet spot. So I want to buy those there and then go out to the 30-ish delta here. And, I don't love going to the half strikes because there's usually less volume and open interest in there, and they have a tendency to be a little wider. And because we're going so far out, XLE has got wider markets. As you can see, that rule kind of applies to when you're closer to at the market for these. So the just out of the monies, 10 cents wide, that works. It's a Friday. I'm sure nobody's got anything left in here, and that's why these are even wider than normal because 40 cents is quite a wide market. And something like XLE, which has a lot of volume and open interest in it generally. I mean, you can see 12,000 contracts have traded, or 12 million contracts have traded in here. All right, so $2.52. So let's call it $2.50 just for math, so I don't have to burn my brain on a Friday. The calls to the upside when this is trading 70 or to the downside is trading 61. Those are our break even. So another thing to go back and look at. Okay, well, I picked those strikes. Do I think it is able to get there? It's got a 70% probability of the market rallying and testing these 67.5s, and it's got about a 70% chance to get to here. Well, it's got a 40% chance to get all the way to here, which is that where we were talking about was our break even. And the other thing we can do is just look at the delta to the upside to get up to the 70s, right? We look at the 70 delta, it's a 19, let's call it 20 for easy math. It's got a 40% probability to get all the way up there. You will be profitable if this starts moving rather quickly, even before you get to that quote unquote break even in a sense. Because remember, that break even is when the premiums decay to zero. It's that break even comes into effect when we're talking about at expiration what it needs to be at the final day, because the premiums decayed to zero. You need to be there by that end of the day. So if this happens rather quickly in the next 10-15 days, you're going to see these premiums increase precipitously. So it doesn't necessarily have to get to that quote unquote break even of 70. That break even of 70 is at expiration, and that's something to be very cognizant of. We got to know what our break evens are in a sense, because that's our goal to get to there. But if this, if I put this on Monday and in 5 days it rallied up to hit these 67.5 calls, I can almost assure you, you're probably at that 50% increase in the premium that we paid here. It's probably, if it was in 10 days, I'd be getting out of it for probably 20-30% increase, right? So for that 50% increase, we're going to be looking at getting out of this when it's trading $1.25, or get out of it when it's trading $3.75. And if it rallies up there in a few days and hits that, I can almost assure you, you're going to be very close to 30-50% of your max profit or increase in profit and achieving your profit target. Okay, because I have a tendency to keep chatting about these, but that would be a pretty good one. Go back and check 70 to 65 or the 67.5. 70 is good, because to me, I think the disruption, I'm kind of bullish in oil. Disruptions and stuff like that are going to kind of start showing up a little bit more. But having said that, volume and open, if we look at this chart, 68, there's a volume node there. That means price has been accepted at these levels here, and price has been accepted up here at the 70 area. So in a sense, those are kind of like magnets. The market's comfortable at those levels. And have a tendency to migrate towards those nodes, if you will. So I would be comfortable with something like that, and if the market goes to put, then nobody's buying oil, and Saudi Arabia, OPEC breaks up, you can get that massive move to the downside. All right, so on to the next one. Home Depot. Home Depot could be another one where, they could blast off. Lowe's is another one, just with the hurricanes and Houston and Florida. Basically people are going to be needing Home Depots and stuff like that, especially the DIYs, do-it-yourselfers, DIYs is what I should have said. But anyway, so it gets above this area here, it could blast off, or it could blast back down to where the 200-day moving average lines up with the high volume node, where that's where price is accepted in a sense. So 145-ish, let's call it, to the downside. So in Home Depot, we'd be looking at it. Looking at implied volatility percent, 22. That's pretty low. That's pretty good. So if we're going to go out past 35 days, we do have November, which is good in Home Depot. Look for the 30-ish delta right here. So buy the 2s or the 30s there, and probably buy these 150s in a sense. So 375. You could go a little tighter. I just don't like to pay a ton for these. I'd like to kind of put it in that 30 or more. You could probably switch it up and make those the 55s, because that's really, you can see you're paying a lot more for that than almost another $1.50. So maybe I'd do the 150s to get away from that. All right. So that's about it. The main idea is kind of go shoot closest to whatever's trading around the 30-ish delta. This one I'd kind of migrate away from it a little bit. But the best ones, like one we were looking at with XLE, it's got a 0 implied volatility percent. So I'd probably be leaning towards something like that myself. ConocoPhillips, XOM, those are all the oil related ones. To try and get that expansion in volatility. XRT, XRT was having high volatility for a while, but it really superseded everything. So, Manny, you were talking about the Qs. I could do the Qs, or maybe not if I don't put in all of them. Don't think I'm going to be able to have time to get to everybody, so I'll kind of do this one and then do the one I vetted after this. So 30-ish delta, we're going to be looking at the 118, so we're going to be buying that one. Oh, I did that other one as a sell. I'm sorry, you guys. I should have done that. I set that up as a sell. And then the closest to the 30-ish, probably, what do we want to do? It's kind of a pick 'em. I did the 30s there, so I'd probably go a little bit tighter on this one. So $3.17, that's pretty good. Go back and look, to the upside. We got to get, to 150. That might be a tough row to hoe, but Q's made a new high today. I was going to say E-mini S&Ps and Dow were kind of pushing higher last I checked, but I didn't look at the Q's. So anyway, 145 to 138, they're kind of winding up. All of the stocks, I mean, you can look at the S&Ps as well. They are kind of getting wound a little bit tight. They've been trading, actually, let's look at the X. Just whenever you start getting this wind, like this, you get the wind and then boom, you get these big moves, just kind of like snaps. We're kind of winding tight again, and I think we could see a snap to either direction. So that would be good. And the Qs, the Qs are, $100 stock, right? So, or it's not a stock, it's an ETF, I know. But it's $100 and it's actually 140. So if we moved it that way, 15 cents would be our kind of idea there. But you can see they're 4 cents wide. That's great. They're probably about 4 cents wide way out here as well because there's so much participation in these, 6 cents wide. So that's a great market. And we did the November. So that would be a good example. Do you put in sell orders after taking on a position? Jim, that's a good question. I don't, for some reason, I just don't in my margin account, but my margin account is bigger than my IRA. In my IRA, I usually put those in there. I can't, other than, I don't know, I don't have a whole lot of orders in my IRA, so I have a tendency to put those in there. And then when that clicks off, I just check over to my margin account to see if they're in there. But yeah, I do it a lot. In my margin account, not so much because I have a lot of other different working orders in there on any given day trying to get different trades on. So I don't want those GTCs to kind of be in there and kind of confusing me. Usually I set up the trade in my margin account and then I'll go and put it into my IRA. And then when I get out, I put the resting orders in my IRA to notify me of my margin account, I guess. It's kind of the way I work that. Does that answer your question? So I'm a little different. I don't have a problem with putting it in there. It makes you stay mechanical. One thing I did not mention at the beginning was when you set up this strategy, when we're going through this process, if I go decide to put this trade on, take that $1.50-ish, that you're looking to get increase in price and add that in there. So at $4.60, that's when I'm getting out of this strategy. Write it down. If you don't put that GTC in after you get filled on this trade, write it down. When I'm getting out at $4.60, because when you write it down, you guys, you're going to be more mechanical about getting out of it. And that is the big difference between long-term traders and short-term traders. Is long-term traders have a plan, they stick to it. The traders that don't last in this business are the ones that don't stick to what they thought in the beginning. They start second guessing themselves and then talking themselves into doing something different, and then it blows up in their face. And if you guys watch my daily market commentaries, I've been like, the other day I waited one day, I didn't go through with it, and for some reason talked myself out of it, and it went against me, and I ended up losing on the trade. And I wrote a sticky note on my right here on my desk, stick to the rules, because there was that one time I was kind of like, I just moved too fast, and I'm just getting tested on probabilities. Well, I'm just getting and then I kind of talked myself out of it, and I was like slapping myself, don't do that again, bad boy, bad boy. So I wrote a sticky note here and stick to the rules. So I write them down too, and everybody does it every once in a while. You just the more mechanical you are, the longer term trader you'll be. And that was one of the rare occasions I did not stick to my rules, and it blew up in my face. So and that's another reason why we take less than max profit potential. Like I'm not going to ride this thing out into the last day, because probabilities are against me. And if the probabilities are against me, why would I risk any more? If I'm making money on this trade, get out. You're beating the probabilities. It's like if you're in Vegas, the probabilities are always against you. If you go down and sit at the roulette table or blackjack table or the craps table and you're out money, get out of there. You beat the probabilities. The pit boss is going to come up and try and give you a nice stay so that you lose all of that and more. That's what they do. That's why they give away free rooms, you guys, because they know the probabilities are in their favor. Or get you a dinner so that you get tired and lethargic and go back out there and lose money. That's what they're doing that for. They're not doing it because you're a great guy. Yeah, stop drinking and get out. Actually, order one more drink, Manny, and then walk over and walk around. So I like to people watch at Vegas more than I like to sit down at the tables. But if I got a bunch of buddies there, I'll do that too. All right, so let me do one more. I was going to, like Goldman's, the financials, I think, should see a little bit of a volatility expansion. Goldman Sachs is pretty low. MasterCard, I didn't zero out for me. MasterCard's another one. So MasterCard, I think, I have a position on in this one, so that won't be a very good example. Let's go back to Goldman Sachs. I don't want you guys limbing off with me. And of course, Goldman Sachs doesn't have the November, but they probably will on Monday. So we can kind of just look at it for an example here. It's a $200 stock, so this is a big boy stock. And you're going to have to pay a lot for this. And this would be even one that, like in a $100,000 account, I might only do a one lot in it. Yeah, anything less than $10,000 account, smaller accounts, I probably wouldn't be playing with this one, because a one lot is going to cost you $1,000. Okay. So in a $10,000 account or less, it's just way too much risk. It's way overweighted. You really have to have a lot of things go in your favor. So this would have to be something that goes into a larger portfolio. All right. So, and those premiums, I'd probably even I'd probably put this to the side on that. I thought that was a good example earlier on, but I might have been looking at the earlier. Problem with Goldman Sachs is the spread on the strikes, right? 25 cents probably should be, but to go to look here, should be 25 cents. And it's right there. It's inside of 25 cents, but it's $200 stock. Move it 2 ticks, 22 cents, 25 cents. So that's close. But you're right. It is a little wide, but they're also a little wider on Fridays after the close, because people don't leave, during the week, people will leave orders in there overnight and stuff, but usually on Fridays, people have a tendency to pull the ripcord on those. All right. It has to move $5 from $2.20 to $2.25. It actually has to move $5 $5. It actually has to move really, at the end of the day, $10. But if it moves up there and trades up to, rather quickly, which I'm not going to stick in this trade for very long because I don't want to, it's a low probability strategy and these options are going to decay. So, it's got to trade up to 140 and I bet I would be profitable if it happened rather quickly. The break even is at expiration and we're not riding this into expiration as far as I'm concerned. Okay. Does anybody else have any other questions? Like I talked a lot about probabilities, talking about the probabilities here, talking about the probabilities with the delta, 2 times the delta. The reason why is because when I was first starting trade, I thought I was a pretty good trader when I was in college. I was doing covered calls and stuff like that. And I went up to Chicago, started trading, got my badge, got into the pits. A couple weeks into it, one of the biggest traders in our pit came up, was talking to me. We used to call him the whale. And he's like, how you doing? How's trading going? Da, 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 da. I'm like, I'm pretty good. I'm up this, X amount of dollars. And he was like, you got a long way to go, kid. And I was like, what do you mean? He was like, until you can stop thinking about trading like money and you think about it as probabilities and percents and things of that nature, he was like, you're still going to be a rookie. And as soon as you can start thinking about probabilities and max profit potential and knowing where your entry and exits are, he was like, you've gotten nowhere. You're going to be too emotional. And that struck a chord with me because when I was in college, I started out with a psychology degree and switched it over to finance. And one of the things on the floor, basically after that point was the psychology in and around the market and the psychology of yourself and how you play around with this. And if you can stop thinking about it as money and start thinking about how the probabilities of success are increased or decreased and how they're in your favor or if they're gone against you, you're going to be a lot better trader because you'll be more mechanical. You'll be like, okay, the probabilities went against me. Just like I talked about in Vegas. You sit down at the table and the probabilities go in your favor and you're up a ton of chips. Get out of there because you beat the probabilities. Don't start risking anymore in that idea. So, with options, the beauty is you can turn the table and you can become the house. And that's when you have the probabilities in your favor. So the idea is to turn all of these probabilities in your favor. I talked about the probabilities of this strategy being rather low with like a 60% probability of success with this. Well, that's over 50%. That's over anything you're going to get in Vegas for one. But the probabilities actually increase even more, and you can't really do math around it. But if you have the idea where you're at a very low implied volatility percent, like 0, and volatility expands, that increases your probabilities of success, right? Because you know that your premiums are going to increase. So it kind of staffs off some of that. And with this options premium membership, 2 months for the price of one is a great deal. This is in your chat window. We've been going back and forth basically in the questions box. This is going to be in the chat window, the link for this, so you guys can take advantage of it at any time. There, I just fired it in there. But basically, you get daily market commentaries. That's where I talk about every single one of my trades, whether it's good, bad, winner, loser, staying mechanical. I'm basically on the verge of talking about my Boeing trade where I have a short strangle on that. I'm going to have to become mechanical. So I'm going to show you in these daily market commentaries, and I have webinars on them as well, but I'm going to have to be mechanical. I'm going to have to start getting a little more aggressive with that trade in order to increase my probabilities of success. So, I do 10, 15-minute videos where I talk about the geopolitical environment, all the earnings data for guys, and I talk about the economic data that's coming out. So, and how that should affect the different markets. You also get access to the online trading workshops, the Wolfman options, trading lessons, video archives, which are a little bit slower or shorter, I should say, quicker refresher kind of videos that I've done on basically all of the options strategies. And you also get top options trading lessons video archives. And with this, you guys, like I mentioned, you get the daily market commentary, but you get access to me. So if one of these strategies goes against you guys can reach out to me and I will get back to you immediately. And if I have to write a page-long email, I'm not going to do that. I'm going to say, hey, listen, let's get on the phone, let's talk this out, or Skype, and walk through this so that I can help you out. Because I know when I have a trade going against me, especially when I was a newer trader, first thing I was thinking was like, what am I doing here? And I was fortunate enough to have many mentors on the floor that I could go and talk to. And I know how valuable that is. So you do have access to me, and I have a no inbox policy, which means basically I'm answering every single email I can as soon as I can. So as soon as I see it, I'm going to be trying to get back to you, whether it's, hey, give me a couple of minutes, I'm in a personal fast market, or give you an email, or say, hey, let's get on the phone and talk this through. So you have access to me, and a lot of you guys take advantage of that, and I know you guys have done well from that. But at the end of the day, if you want to become a better trader, you guys, you got to constantly learn, and obviously you've done that. And if you take advantage of this premium membership offer for only $97, you guys are well on your road to doing that. I know you guys have already started that journey by participating in this webinar, and that's the first step. But at the end of the day, wouldn't you guys say that just knowing how to create a strangle, or just any option strategy, or just even trading the technicals isn't enough to create consistent winners? I mean, you guys are looking for some mojo. This is it. Basically what I mean is trading technical analysis or just building strategies. The real way to get ahead in this game is to trade higher probabilities and become more mechanical. Anyone, like I said, many times can teach you how to do a strangle or a straddle or any of these option strategies I'm talking about, but who's telling you what strike you should do and why you should pick those strikes, and more so even what type of volatility you should be thinking about? A lot of people don't talk about volatility because they don't really understand it. I mean, I've heard Goldman Sachs say, go out and buy calls going into an earnings for XYZ 5 days before, and then cover them, the day after. What? Volatility has expanded. You probably were profitable, and even if you were directionally right, that volatility coming out of those calls, you were probably decimated. And please don't listen to like Goldman Sachs and some of these guys that are talking heads on the different outlets of mainstream media, because at the end of the day, I've traded with some of them, and many of them don't know what they're talking about. So if they're not talking about the minutia, and all they're doing is, hey, I had the cherry picking their best trades, I had this great trade and I made so much money on it, those are probably the guys that are snake oil salesmen. I'm talking about the good and the bad and the ugly. If you watch these daily market commentaries, you'll see that. And I teach how to trade the probabilities, when the probabilities have gone against you, how to stay mechanical, how to increase those probabilities even further in your favor, like I talked about with this Boeing trade that's kind of going sideways on me. I'm going to start getting mechanical with it to create more, and that all creates more alpha, you guys. Right? So when you're trading with the right tools and the right situations, you're going to be more productive state of mind. You're going to put on more strategies. You're going to create more opportunities and ultimately build more confidence and become a better trader. You're going to be, you're going to be able to be more sane. You're going to sleep at night. So we're offering this trial today for you guys. And if you are on tape delay and have had this sent to you, you can pause it and type in this. But what do you say, guys? Go ahead and click on that in the chat window. I think everybody can see it. I see a couple of people have already clicked on that. And if you've learned anything at all from me today, you guys should be trading with this knowledge and taking advantage of that link right there. All right, so we'll get you set up straight away. And if you have any questions, like I said, you can reach out to me. In later webinars, I'm going to be drilling down on different options, components, when and where I find these trades, when they're appropriate, things of that nature. If you guys have seen my videos and stuff like that, you haven't seen an option strategy that I haven't covered yet, or if you want me to go over something, please reach out to me. Love to do a webinar on something like that too. Here's also the link. You'll have to pause it and write it down or punch it into your URL because it is a dead link on this video. And thank you for watching. If you have any questions, you can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, got all that out with just barely a voice left. I appreciate all of you guys jumping in. I'll answer some of your questions. I see some people are blowing me up with questions right after this, but yes, the link is in the chat window for the $97 offer, you guys. It's 2 months for the price of one, and you get all this stuff. For some of you guys that are asking, I'm not going to bore everybody with reading over all of it again, though. All right. Would you talk about weekly options in the near future? Farshid, I will. You know what? I'll start doing that in the daily market commentaries, Farshid. And I do weeklies a lot. We're getting right into the earnings season. I do the weeklies all through earnings season. Sorry if my phone is blowing up and is across the way. Volatility crush, Manny, I missed you. You got something out there and left. Andrew, appreciate it. Thank you. Appreciate your kind words. Can definitely hear the difference between info you provide and lectures from experts who have never worked on the floor. Thank you, JQ. I appreciate that. That's what I'm trying to bring, something fresh to it. You know, I mean, I know everybody can go online and read this, how to do a strategy, but they don't generally tell you. David, I'm atypical. I don't know what you mean by that. That's the first time I've heard that, be called atypical. What I miss? When is the best time to use this strategy? When you think that volatility is either going to expand or you think there's going to be a big move. Now, like I mentioned early on, you may have missed it. Watch these videos a couple of times in a row. I know not everybody's got a bunch of hours to do that, but watch them again because it'll really sink in. And I talked about something like, not necessarily MGM, but Boeing. I like to do it when the rubber band's getting wound really tight. It's kind of like, I look at it like those old school airplanes where it's got the rubber band, you wind up the propeller. Well, the longer you wind that propeller, right, the tighter that that rubber band gets, and the faster it spins as soon as it releases, it snaps. And as you can see, it's kind of similar to what Boeing has done. You know, this was an earnings gap because they did good, but then it settles down, right? But then that gets really wound tight, and all of a sudden, boom, boom, boom. There's no news coming out around Boeing. It's just all of a sudden it had to snap one direction or the other. So that's one of the times I really like to implement this strategy. Other than that, I go over all the rules. I don't really have the time to go over it all again, David, but that in a nutshell is it. All right. Thanks, Eric. You have all my good Farshid. You have all the materials and are on the daily market commentaries. I'll start doing that a little bit more for you too. Do you have recordings of this webinar? Yes, we are. It's going to take me about an hour to compress this or convert it and then send it off to home base, and it should come out either tonight or tomorrow. All right. All right, David, appreciate your kind words. Thank you. And like I said, there you go. Links in the chat window. I hope you guys took advantage of that. All right, if you can't take that, take it easy. JQ had it already queued up. Thanks, JQ. Watch out for desert throat. I think I have it. I'll likely put the trigger on your offer. Thanks, David. I appreciate it. And please reach out to me if you have any questions whatsoever.